if you're looking at if we're in a recession, which we may be, that's a separate topic, you may have to cut because of the recession, because of rising unemployment.
In this interview, Jim Rickards discusses the factors driving inflation, particularly focusing on the impact of rising oil prices. He explains how the reduction in oil production by major suppliers like Russia and Saudi Arabia, coupled with geopolitical tensions and supply chain disruptions, contributes to inflationary pressures. Rickards criticizes alternative inflation metrics like CPI core and PCE, arguing that they don't accurately reflect real-world consumer spending patterns. He warns that inflation may transition from being supply-driven to demand-driven, fueled by psychological factors like expectations of future price increases. Rickards expresses concern about potential stagflation, citing historical examples and challenging the Federal Reserve's assumptions about the relationship between unemployment and inflation. He predicts that the Fed is unlikely to cut rates before the upcoming election due to political considerations, but acknowledges the possibility of rate cuts later if a recession occurs. Overall, Rickards paints a picture of a complex and potentially precarious economic situation with significant implications for both policymakers and everyday consumers.
The price of oil and the price of refined products, gasoline, kerosene, which is jet fuel, and diesel, go up, and then everything goes up. So that's one of the drivers. It's not the only one, but it's one of them. And how's it going to change in the short run? The two of the three biggest oil suppliers in the world are Russia and Iran. Russia and Saudi Arabia. Russia and Saudi Arabia. U.S. is the other one. Well, Russians and Saudi Arabia, and by extension OPEC, they're called OPEC Plus, are cutting down on production. Now they're fighting a tide. I mean, the world kind of wants to deflate or disinflate. That's what the world wants to do, and that is happening around a lot of the rest of the world. It's not happening in the United States, but there are other reasons for that, including concerns about the geopolitics. Iran just hijacked the cargo vessel in the Straits of Hormuz. The Houthis have shut down the Suez Canal. The big oil tankers are going around the Cape of Good Hope in South Africa. It's a long way. The oil is still getting through. I'm not saying that you're not going to be able to get gasoline. I'm just saying that if you add transportation costs and time delays and geopolitical uncertainty and other factors on top of what we've already seen, this is what you get. Now, you can get into some really esoteric discussions. I think they're best avoided because they don't add much. The economists, I always say, when they dream up these things, it's because they don't have enough to do. So what I talked about CPI. Well, they invented CPI core. What's CPI core? Well, that's when you take out energy and food. And that's a little more well-behaved. Well, thanks, guys. The energy and food is what most people spend most of their money on. So if you can take them out and get a different time series if you want, but that's not what people actually pay. They pay CPI. And then they came up with something called supercore. Well, what's supercore? Well, supercore, you take out food, energy, and housing. Okay, so if you live in a tent and eat canned goods, fine. But those are the three biggest things that people spend money on: food and energy, gas at the pump, food at the grocery store, and housing costs. And then of course the energy price feeds into home heating, air conditioning, whatever you have. This is like 70% of the average household budget, maybe more. And they say, well, we don't count that because we're eggheads. And then take everything I just said, and there's another inflation index called PCE. Personal consumption expenditure. That's the one the Fed uses. Same thing. PCE core, PCE supercore. It's all garbage. I mean, you can compute it. I understand it. I can look at a spreadsheet or an equation and understand it. But I also understand that that's not what people pay. People pay CPI. That affects their attitude towards the economy. That affects their political outlook. That affects everyday behavior. It affects other consumption. If I'm spending more at the gas pump, okay, I have that much less to, go out to dinner, buy a show ticket, or, some new clothes or whatever it is. So this has ripple effects that are enormous. Some people, I would say theoretically, you can distinguish between supply side inflation and demand side inflation, and the difference really quickly. Supply side is kind of what we've been talking about. So, oil shipments are reduced. The bottlenecks go back to 2021, 2022 when the supply chain broke down. And there are, concerns about that. economic sanctions coming out of the Ukraine war, new economic sanctions on Iran. Those are all things that affect the supply side. But a funny thing can happen, which is if it persists long enough, it leaches over or spreads over to the demand side. The demand side is psychological. It's people saying, this inflation, it's hanging around longer than we thought. It's getting worse. I was going to buy a new refrigerator in 6 months. Maybe I better buy it now before the price goes up. And then, a new car or, furniture or whatever it might be. I better go get it now before the price goes up. That is a psychological, behavioral factor. But if enough people do it, guess what? Again, you start bidding the price up, the manufacturers can't keep up, et cetera. I think we're in a very dangerous place, meaning the inflation right now, what we just talked about, is coming from the supply side. So that's pretty clear. But at what point, or does it kind of tip over into the demand side? We're starting to see that. We're starting to see pretty good union contracts are getting pretty good raises, and other minimum states are raising minimum wages, et cetera. A lot of that's counterproductive. Certainly, the minimum wage tends to lose jobs, but in the short run, if you have to pay people more, you're going to raise your prices. Somebody went into a McDonald's in California the other day and ordered like a normal meal. I don't know, 12-piece chicken, a Big Mac, whatever. And it was like $25. You don't go to McDonald's to spend $25. You might as well go to a restaurant. But that's how the California minimum wage law is starting to filter through into prices. So it may tip over to the demand side, but in the short run, Wall Street, I'll just wrap up by saying the following, Matt. Wall Street has been wrong for 2 years. By the way, the expectation today is that there may be no rate cuts through the end of the year. I think that's probably right. Certainly not in May, not in June, probably not in July. And then, of course, the Wall Street Bureau, they're always out of touch. They're staring at the screens all day. So they say, yeah, okay, you're right. Not June, not July. So they're going to raise in September. Are you kidding me? The September Fed meeting is 5 weeks before the election. Do you think that the Fed wants to walk into the election buzz off? They cut rates in September after not doing it for last time they cut rates. 2020 was the last time they cut rates. So they don't cut rates for over 4 years. 5 weeks before the election, they cut rates. That is so obviously trying to help, or appears to be helping Biden and hurting Trump. And by the way, right now, it looks like Trump's going to win. That's the last thing the Fed wants. That people say that the Fed says we're not political. They are highly political. Trust me. I've worked with senior Fed officials and been partners with former Fed vice chairs. I spent a lot of time with the Fed as a regulatory lawyer. They're highly political. They read the papers, as the saying goes. But so they're not going to cut in September just for political reasons. Then now November, December, if you're just looking at inflation, you're not going to cut. But if you're looking at if we're in a recession, which we may be, that's a separate topic, you may have to cut because of the recession, because of rising unemployment. But the Fed thinks that can't happen, and Wall Street thinks that can't happen. I have news for you. It can happen. It has happened. So what do you call the combination? The Fed's assumption is if unemployment's low, inflation gets high. If unemployment goes up, inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time? The Fed thinks that can't happen. It has happened. It's called stagflation. Stagnant growth with inflation in prices. I lived through it in the late 1970s, early 1980s. I think around the 1979, 1980, unemployment was 10%, but interest rates were 15%. So don't tell me unemployment and interest rates move inversely. Sometimes they do, but sometimes they can both go up together. It's called stagflation.